Okay, let's talk now about the fixed interest side of things, the money market side of things. In the studio with me in Cape Town is Ian Scott from PSG Asset Management on that very subject, head of fixed interest at the institution. So never mind the share price, it came down 60.75%. I'm sure some of the fund managers that are the big holders would have had a lot to comment on if it had gone up 60.75%, but that's another matter. Tell us the impact on the money market, or the potential impact.
Good evening. And firstly, I'd like to state that we at PSG Asset Management have got no any sort of stake in Able or any exposure to any of their securities. And I've been watching your interview, and it's been interesting that for about more than 2 years now, we've actually seen that the red lights have been warning us on Able, especially in fixed income securities, because when you think about money market funds and the R1 price, you say, well, in fixed income space, your yield or your spread that you earn can never compensate you for the risk of default. So when we go back to our process and we push Able through our fixed interest process and our model, we say, well, in terms of what we call our margin of safety, we say, well, Able just did not meet our margin of safety requirements to warrant an investment in a conservative space like a money market fund, because there's real risks in Able. And if we look at our philosophy, we say risk comes first. And Able is the type of risk that we don't want to put into a fixed income investment, especially over the last 2 years. It's actually been on our embargo list at PSG Asset Management, because the risk is just too high, because we don't want to expose the conservative portion of people's investments to that type of risk. Because we've had a very good time in credit markets, that we've seen spreads come down. It's been a risk-seeking behavior ever since we've seen quantitative easing enter the world. And everybody's been looking for yield, but at what price?
Yes.
And we're very concerned for...
Dash for trash is a phrase that keeps on coming up with people I speak to overseas. Let's get to Mark Ingham's view. He's in Johannesburg.
Ian, just from my side, we've got various bondholders out there, sort of Swiss bonds. They were trading at the 100 mark not too long ago. They obviously tanked sort of today. We've got the local medium-term notes and various other funders that are actually sort of exposed here. Ian, what's your sense? I know your company isn't exposed, but for those that are exposed, where to now?
I think there's very little space for them to run, because there's no active market in fixed income assets at the moment. Nobody really wants to buy those assets. I think there is a risk there for those investors sitting in those fixed income assets at the moment. And we've seen how the spreads have widened, especially in the Swiss market. If you look at the 2015 maturity bond of Able, it's trading at a yield of around 23% at the moment, which is probably around 80 cents in the rand. If we look at the 2018 bond, it's trading at around 60 cents into the euro, if you want to call it that way. So there's a lot of risk for fixed income investors in Able paper at the moment.
Ian, I'm not too sure if this is outside your scope, but I want to pick up on a tweet from one of our viewers, Tamsan Neta. He says that basically he sees an opportunity here for a private equity deal. Is this something that you might agree with?
I'm not an expert into private equity, so I wouldn't be able to answer that question. But for us, what is the risk? And we always put risk first in our philosophy.
I think what we're saying here is there some rescuable scheme that could come up for Able, whether it be with their bonds, whether it be with their Ellerines, whether it be with the good bank and the bad bank, which we haven't even spoken about yet. Is this situation rescuable? Some people that I've spoken to today on my radio show have said, this is it. Just get out now if you can, because there's going to be nothing. Other people are saying, no, that's absolute nonsense. There's a Reserve Bank put, there's a shareholder put, and they still have some assets. What's your view?
It's very hard to say what the Reserve Bank will do. I think the last time we've been in this situation was in the early 2000s with Sambo and Unifer. I think the SARB would be interested to maybe have a semi-bailout. I don't know if it would bail out the institutional investors, but it will probably have a look at the deposit holders, the account holders, because that's a model that we've seen from the Fed and from the ECB. But no assurances has been given by the SARB, and we know that they're looking at the, call it, systemic risk in the banking system, which they came out and said, well, the Able exposure is not systemic to the whole banking system. So we don't know what form the SARB will come out in bail.
Just as a last note here, I mean, on that Sambo situation, there was a major bank that is still listed on the JSC that mopped up some assets and did rather nicely out of them. Maybe someone's sort of circling at the moment and might do the same thing, should it come to that.
I would not be surprised. I'm sure that the major banks will come in, even a Capitec could come in and bid for the book and at a certain price. And if I can recall correctly, the SARB actually gave some sort of loan to the guys who bought Sambo at that point in time. I can't recall.
Yeah,
but it was 14 years ago.
The principle is there. Ian, thanks very much for your time this evening. That's Ian Scott, who's head of fixed interest at PSG Asset Management.